Listen. Sit down. Pour yourself a strong coffee because what I'm about to walk you through is going to make you absolutely furious, and I need you sharp for every second of this. You finally did it. After 43 years of waking up at 5:47 in the morning, after 43 years of suffering through quarterly performance reviews, after 43 years of maxing out your 401k match like every personal finance guru on cable television begged you to, you walked out of that office for the very last time. Maybe they gave you a cake. Maybe they gave you a plaque with your name spelled wrong. Maybe HR just sent you a Microsoft Teams emoji that said, "Good luck on your next chapter." And that was that. You drive home. You sit down at your kitchen table. You open up your laptop and you log on to the Social Security Administration's clunky 1998-looking website, and you click the button. You file. You claim your benefit. 67 years old, full retirement age. The system is finally going to start paying you back for 43 years of FICA withholdings that you never volunteered for. That came out of your check before you could even see the money that they took from you for an entire working lifetime. You feel a wave of relief wash over you. You've got $512,000 sitting in your traditional 401k at Fidelity. You've got another $84,000 in a high-yield CD because the bank lady told you that was safe. You've got $46,000 in a taxable brokerage account at Schwab, full of dividend-paying blue chips your father told you to buy in 1994. And you've got Social Security coming in at $2,847 a month. You did everything right. You followed every rule. You ate the ramen in your 20s. You skipped the Caribbean cruises in your 30s. You drove the Camry until the odometer flipped past 240,000 miles in your 50s. You won the game, except you didn't. Because 9 months from that triumphant moment, when April rolls around and your accountant pulls up your tax return on her screen, she's going to look at you with that pinched, slightly nauseated face that accountants make when they have to deliver bad news to a client they actually like. And she's going to tell you that $24,200 of your Social Security is now taxable. Not 50%, not 70%, 85%, the federal maximum, the legal ceiling. The IRS has reached its hand directly into the check that the government has been promising you for 4 decades and clawed back nearly a quarter of it. And then on top of that, every single dollar you pulled out of that beautiful $512,000 traditional 401k to pay for groceries, for your wife's knee surgery copay, for the new roof in Tampa, every single one of those dollars got taxed at ordinary income rates. And because you pulled $48,000 out of that 401k over the year to live a halfway decent life, you didn't just trigger taxation on your withdrawal, you triggered taxation on your Social Security. The 401k was the bullet. The Social Security check was the body. The IRS pulled the trigger, and the worst part is, you handed them the gun, you loaded it, and you put it directly against your own retirement. This, my friends, is a crime scene, and I'm here to walk you through every piece of forensic evidence, every bloody fingerprint, every footprint in the snow, because the perpetrator is still out there, and they are coming for the next retiree, and the next, and the next. And they have been doing this since October 1983, and almost nobody, not your financial advisor, not your tax preparer at the strip mall H&R Block, not the smiling representative on the Social Security hotline, almost nobody is going to tell you the truth about what just happened. I'm the retirement insurgent. I read the tax code so you don't have to. I dig through the Internal Revenue Bulletins, the IRC sections, the Treasury regulations, the tax court memoranda, and I translate the bureaucratic poison into actual English so retirees can stop getting strip-mined by a system that was deliberately designed to confiscate the savings of disciplined, hard-working, middle-class Americans. And right now, before we go one in further, I need you to smash that like button. I mean it. Smash it. Because Washington counts on you not knowing how provisional income is calculated. They count on you scrolling past this video. They count on the algorithmic shadow ban that quietly suppresses senior financial truth so that millions of you keep filing for Social Security at the wrong time, in the wrong order, with the wrong accounts. and keep funding the federal deficit with money that was supposed to be yours. Hit the like button, break the suppression, force this video into the feed of the next retiree who's about to make the exact same mistake. And while you're at it, subscribe and flip that notification bell because I am dropping these forensic breakdowns 3 times a week, and you do not want to make a claiming decision that triggers a 20-year tax disaster because you missed the Tuesday upload. Join the archive. Join the people who refuse to be fleeced. Now, the suits and the lawyers and the compliance department at every brokerage in America want me to remind you that what you are about to hear is not financial advice. It's a survival guide for an unguarded vault. Consult a professional if you still trust the people who are trying to tax your Social Security check for the 3rd time in your life, after already taxing your wages, taxing your interest, taxing your dividends, and taxing your purchases. I am giving you the math. I am giving you the code sections. What you do with it is between you and whatever shred of common sense you still have after listening to mainstream financial media for the last 20 years. Here is where the crime begins. The year is 1983. Ronald Reagan signs the Social Security Amendments. Congress, in their infinite wisdom, decides that for the first time in American history, Social Security benefits, which had been completely tax-free since 1935, were now going to be taxable, but only for high-income retirees. They drew the line at $25,000 of provisional income for a single filer and $32,000 for a married couple filing jointly. Above that, up to 50% of your Social Security got thrown onto your tax return. Then, in 1993, Bill Clinton's administration added a second tier. Above $34,000 single and $44,000 married, up to 85% of your benefit became taxable. Those were the numbers: $25,000, $32,000, $34,000, $44,000. And here's the part that should make you absolutely livid. The part I want tattooed on the inside of your eyelids. Those numbers have never, not once, not by a single penny, been adjusted for inflation. Not in 1990, not in 2000, not in 2010, not under Bush, not under Obama, not under Trump, not under Biden, not in the so-called One Big Beautiful Bill of 2025 that everybody on cable TV was breathlessly celebrating last summer. The $6,000 senior bonus deduction they threw in? Sure, that helps a little. The expanded standard deduction? Sure, fine. But the provisional income thresholds? Frozen. Cryogenically preserved. Sitting in a Smithsonian display case from the Reagan administration, while everything else around them has tripled, quadrupled, quintupled in cost. Think about what $32,000 bought a married couple in 1983. A modest home in Cleveland cost about $54,000. A gallon of gas was 91 cents. A loaf of bread was 70 cents. Medicare Part B premiums were $14.60 per month. 32 grand in 1983 was a comfortable, lower middle-class income. In 2026, $32,000 doesn't even cover the property taxes and homeowners insurance on a paid-off 3-bedroom in Pinellas County, Florida. It doesn't cover the Medicare Advantage premiums, the supplemental drug coverage, the dental work, the eyeglasses, and a single trip to see your grandkids in Phoenix. $32,000 is by every objective measurement a poverty wage in modern America. But, to the IRS, you are still wealthy the moment you cross that threshold. And they are still going to use that 43-year-old unindexed, deliberately frozen number as the legal trigger to tax your Social Security benefits. This is not an accident. This is not bureaucratic incompetence. This is not, they just forgot. This is bracket creep weaponized. This is a stealth tax, mathematically engineered in 1983, programmed into the IRS computer systems, and quietly metastasizing for 43 years while inflation does the dirty work that Congress doesn't have the political courage to vote on directly. They never have to raise the tax. They just let inflation drag every middle-class retiree across the line. It is, and I am choosing this word carefully because I want you to feel the weight of it. Theft. So, before I show you the 4 accounts you need to drain, before I show you the math on how to legally vaporize this tax, I want you to drop a comment below. Tell me, right now, in the comment section, at what age are you planning to claim your Social Security benefit? And do you currently have money trapped inside a traditional 401k or a traditional IRA? Give me the rough balance. I read these. I track them. We're building a field report of exactly how exposed this audience is, and your comment helps the next retiree understand they are not alone in this trap. Now, let's open up the toolbox and pull out the murder weapon, the actual formula, the piece of dirty math that the Social Security Administration absolutely does not advertise on their website. Get a pen. Your provisional income, sometimes called your combined income, is calculated like this. Take half of your annual Social Security benefit. Add to that all of your other ordinary income, which includes wages, if you're still working, withdrawals from traditional 401ks, withdrawals from traditional IRAs, pension payments, interest from CDs and savings accounts, capital gains from your taxable brokerage, dividends both qualified and non-qualified, and rental income. Then, and this is the kicker that 99% of retirees never see coming, you also add in your tax-exempt interest. Yes, the municipal bond interest that your broker swore was tax-free. That gets added back in for this calculation. The IRS lured an entire generation of retirees into tax-free muni bonds, and then designed the provisional income formula to count that supposedly tax-free interest against them anyway. Just absolute legalized fraud at the formula level. So, the math is half of your Social Security plus all ordinary income plus tax-exempt interest equals your provisional income. If you're filing single, and that number is between $25,000 and $34,000, up to 50% of your Social Security gets thrown onto your 1040 as taxable income. Above $34,000 single, up to 85% of your benefit gets taxed. For married filing jointly, the bands are $32,000 to $44,000 for the 50% tier, and above $44,000 for the 85% tier. Look at the dirty math they programmed into those IRS computers. Let me give you a real-world scenario. Meet Richard and Susan. Richard is 68, Susan is 66. They live in the Villages in Central Florida. Richard worked for 38 years at a regional utility company. Susan worked part-time as a paralegal. They are not rich. They are absolutely statistically, demographically average middle-class American retirees. Together, they collect $40,000 a year from Social Security to live comfortably, to pay their HOA fees, to keep the AC running through a Florida summer, to cover their Medicare premiums, to pay for groceries, to fly out to Indianapolis twice a year to see the grandkids. They need to pull $40,000 a year out of Richard's traditional 401k. That's a totally reasonable, totally sustainable withdrawal rate on the $620,000 they've got saved up. Their financial advisor at the regional bank told them this was a perfectly fine plan. Now, watch what happens. Half of their Social Security is $20,000, plus the $40,000 401k withdrawal. That's $60,000 of provisional income. They are $16,000 over the $44,000 married threshold. That triggers the 85% tier. The IRS now reaches into their Social Security check and pulls 85% of $40,000, minus a few adjustments, out. And they end up with approximately $28,900 of their Social Security being added to their taxable income. So, what was their total federal taxable income for the year? $40,000 from the 401k, plus $28,900 of newly taxable Social Security, minus the standard deduction for a married couple over 65 in 2026, which, with the One Big Beautiful Bill's senior bonus deduction, is approximately $34,700, leaves them with roughly $34,200 in federally taxable income. They owe federal income tax on that. They probably also owe state tax, depending on where they live. But here is the part that should make you absolutely furious. Of that $34,200 in taxable income, $28,900 of it would have been completely tax-free if they had just pulled their living expenses from a different account, from a Roth. Watch what happens when we rerun the same scenario. But Richard had converted his traditional 401k into a Roth IRA before claiming Social Security. He pulls the same $40,000 a year to live on, but now it comes out of the Roth. Roth withdrawals do not count as ordinary income. Roth withdrawals do not count toward provisional income. They are invisible to this formula. So, now their provisional income calculation looks like this. Half of Social Security, which is $20,000, plus ordinary income of 0, plus tax-exempt interest of 0. Total provisional income, $20,000. They are $12,000 below the first threshold of $32,000. Result, 0% of their Social Security is taxable. Their federal taxable income for the year, functionally 0 after the standard deduction. They owe the IRS approximately nothing. They have legally, completely, totally evaporated their tax bill while spending the exact same amount of money. That is the difference between a retiree who understood the 4 toxic accounts and a retiree who didn't. Same income, same lifestyle, same Social Security check. One of them gives the IRS roughly $4,800 a year. The other one gives the IRS roughly 0. Multiply that gap across a 25-year retirement, and you are looking at $120,000 of completely avoidable federal tax. That's a new pickup truck. That's 2 years of long-term care. That's the inheritance you wanted to leave your kids, just incinerated, just lit on fire, because nobody told them to drain the right accounts at the right time. So, let's get into it. The 4 toxic accounts. The 4 ticking time bombs that are quietly sitting inside the average American retiree's portfolio, primed to detonate the second they file for Social Security. You need to identify them. You need to diffuse them. And ideally, you need to do it before you claim. If you've already claimed, you can still do damage control, and I'll walk you through that too. But the optimal window is the gap between retirement and your claiming date, especially if you retire at 62 and delay benefits until 70. That 8-year window is a Roth conversion fire sale, and almost nobody uses it. Toxic account number 1, the traditional 401k. This is the big one. This is the account that the personal finance industry has spent 40 years brainwashing you into maxing out. Every dollar you put in saved you a little bit on your tax bill in the year you contributed, and you felt very clever about it. But every dollar that comes out is taxed as ordinary income, and worse, every dollar that comes out counts in your provisional income calculation. The traditional 401k is a tax-deferred grenade. The IRS doesn't care about the deferral. They care about the eventual collection. And they designed the timing of that collection to align perfectly with your most vulnerable years. You need to look at converting that 401k into a Roth IRA in the years before you claim Social Security. This is called a Roth conversion. You pay the ordinary income tax on the converted amount in the year of conversion, but once it's in the Roth, every future dollar of growth, every future dollar of withdrawal is tax-free and invisible to the provisional income formula. The strategy is to do partial conversions year by year, filling up the lower tax brackets, especially the 12% and 22% brackets, before Social Security ever starts. Let me give you the 3-state breakdown. In Florida, where there is no state income tax, a Roth conversion only costs you the federal tax. That makes Florida one of the most aggressive Roth conversion environments in the country. In Ohio, you've got a state income tax that tops out around 3.5% on retirement income, plus various municipal taxes, depending on whether you're in Cleveland, Columbus, or Cincinnati. So, the conversion costs federal plus state, but Ohio also has a retirement income credit that can offset a portion. In California, where the top state bracket can hit 13.3% on top of federal, Roth conversions are brutal, but still worth it for higher balance accounts, especially if you're planning to relocate to a no-tax state later, in which case timing the conversion after the move can save you tens of thousands. Toxic account number 2, the traditional IRA. Same poison as the 401k, just in a different bottle. Every withdrawal is ordinary income. Every withdrawal counts toward provisional income. Same conversion strategy applies, but there's an extra wrinkle. Required minimum distributions, the RMDs, kick in at age 73 under current law, going to 75 by 2033. Once those RMDs start, you have no choice. The IRS forces you to pull a percentage of your account out every single year, and that forced withdrawal is going to crush your provisional income calculation, whether you want the money or not. The whole point of converting your traditional IRA to a Roth before age 73 is to shrink that future RMD down to zero. Roth IRAs have no RMD for the original owner. They are pure, beautiful, IRS invisible vessels. Toxic account number 3, the high-yield CD and savings account. This one catches people completely off guard. They walk into the bank, the teller smiles, says, "We've got a special on 18-month CDs at 4.6%. They put $80,000 in, and they feel very responsible. Then, every year, $3,680 of interest pops onto their 1099. INT gets added to their ordinary income and gets added to their provisional income. Even though they didn't spend the money, even though the interest just sat there and compounded, the IRS counts it. CD interest is taxed as ordinary income, not at the lower long-term capital gains rates, and it absolutely counts toward provisional income. The fix here is to reposition that cash. Some of it should go into a Roth IRA if you have earned income or via conversion. Some of it should go into a non-qualified deferred annuity, which grows tax-deferred and doesn't generate annual 1099 INT income while it's accumulating. Some of it might go into I-bonds, which let you defer the federal interest until redemption. The point is, every dollar of interest that hits your tax return during your Social Security years is a dollar that potentially drags your benefits into the 85% taxation zone. In Texas, no state income tax, so the CD interest only stings you federally, but it still stings the Social Security check. In New York, you've got state and city income tax on top of federal, so a high-yield CD held by a Manhattan retiree is essentially a wealth destruction machine. In Pennsylvania, retirement income is generally exempt from state tax, but CD interest from a non-retirement account is not, so the trap still snaps shut. Toxic account number 4, the taxable brokerage account. This is where it gets sneaky. Most retirees look at their Schwab or Fidelity taxable brokerage and think, "I don't owe taxes on this unless I sell." Wrong. Dead wrong. If you hold any dividend-paying stocks, mutual funds, or ETFs in there, you are generating 1099 div income every single year, whether you reinvest or not. And those dividends count toward provisional income. Even worse, if you hold actively managed mutual funds, those funds can throw off capital gain distributions even in years when you didn't sell a thing. And those distributions also count. The fix is asset location. You want your tax-inefficient assets, your high-dividend funds, your bond funds, your REITs inside your Roth IRA, where they grow tax-free. You want your tax-efficient assets, your broad market index ETFs that throw off minimal dividends, in your taxable brokerage. And if you've got highly appreciated individual stocks, you might consider donating them via a qualified charitable distribution or a donor-advised fund, both of which avoid the capital gains hit and can reduce your adjusted gross income, which lowers your provisional income. This is the part of the video where I need you to do something for me. Share this video. Not tomorrow, not next week, today, right now. Send it to one retiree, one pre-retiree, one friend who is sitting on a 6-figure traditional 401k and thinking about claiming Social Security in the next 12 months. One conversation right now saves them tens of thousands of dollars over the next 2 decades. The system counts on this information not spreading. The system counts on retirees making these decisions alone, in the dark, with no map. You sharing this video is how we break that. Send it. Press send. Move on. Save this video to your private library, your watch later, your favorites, whatever your platform calls it. This is your survival manual. When the IRS sends you the letter you weren't expecting next April, when you're staring at a tax bill you didn't budget for, when your accountant says, I don't know what to tell you. Your provisional income was over the threshold. You are going to want to pull this video back up, scroll to the math, and start running your own numbers. Here's the strategy. The actual battle plan, the insurgent's playbook. Step 1. Pull your most recent Social Security statement and your most recent 401k, IRA, brokerage, and CD statements. Add them all up. Calculate your projected first-year provisional income under your current plan. If it's over the $32,000 married or $25,000 single threshold, you are walking into the trap. Step 2. If you have not yet claimed Social Security and you have any years between today and your claiming date, those are conversion years. They are gold. They are once-in-a-lifetime opportunities. Each year, calculate how much you can convert from traditional to Roth without bumping yourself into the next federal tax bracket. In 2026, the 22% bracket for married filing jointly runs up to roughly $206,700 of taxable income, and the 12% bracket caps at roughly $96,950. Most retirees should be filling the 12% bracket completely with conversions every single year until either the account is empty or they claim Social Security. Step 3. Review your CD and high-yield savings positions. Decide which portion of that cash actually needs to be liquid and which portion is just sitting there because the bank teller talked you into it. Reposition accordingly. Step 4. Review your taxable brokerage for asset location problems. Move tax-inefficient holdings into your Roth via conversion and consider tax loss harvesting any losers to offset gains on winners. Step 5. Stagger your Social Security claim. If you can delay from 62 to 67 or from 67 to 70, you get an 8% annual delayed retirement credit, and you get more conversion years. Step 6. File a fresh W-4V with the Social Security Administration to have voluntary federal withholding set up at 7, 10, 12, or 22%, so the tax doesn't ambush you in April. Step 7. In the year you turn 70 and a half, start using qualified charitable distributions from your IRA if you're charitably inclined, because QCDs don't count toward provisional income. The system that designed this trap in 1983 is the same system that's quietly counting on you to never run these numbers. They want you to claim early. They want you to leave your money in the traditional 401k. They want you to buy the high-yield CD. They want you to hold the dividend-paying mutual fund in your taxable account. Every one of those choices funnels more money into the federal coffers and out of your pocket. This is not paranoia. This is the mathematical, documented, unindexed, deliberately frozen design of the tax code as it exists on the 16th of May, 2026. Before you go, one last ask. Subscribe to the secondary channel, The Archive, where I drop the long-form forensic deep dives on specific code sections, specific state strategies, specific account combinations. That's where the next-level material lives. Join before the system flips the kill switch on your purchasing power, because every quarter that the provisional income thresholds stay frozen at 1,983 levels, another 2 million retirees get pulled into the 85% zone. You don't want to be one of them. Tell me in the comments, which of the 4 toxic accounts are you sitting on right now? Traditional 401k? Traditional IRA? High-yield CD? Taxable brokerage with dividend payers? Or, God help you, all 4? Drop the field report. Tell me your age, tell me your projected claiming date, tell me roughly what you're working with, and I'll respond to as many as I can. We're building the archive together. We're disarming this trap, one retiree at a time. You worked 43 years. You paid into the system every single paycheck. The check is yours. The savings are yours. Don't let a 1,983 formula, frozen in time, weaponized by inflation, and ignored by every congressional session since the Reagan administration, decide how much of it you actually get to keep. I'm the retirement insurgent. Smash the like, hit subscribe, share it today, save it for the letter that's coming, and I will see you on the next.